Hello, I'm David Kain, president of Kain Automotive, and I've got the pleasure today to speak to a dear friend of mine. I wanted to call him an old friend because we are both a little older. We've known each other quite a long time, but someone that you'll recognize immediately because of his orientation to the used car marketplace in particular. His name is Dale Pollak, and he's a senior vice president with Cox Automotive and the founder of vAuto. Dale, would you do us a favor and just tell us a little bit about your background, and then if you could, I'll just ask you a few questions to get things going.
Sure. Well, thank you very much, David, and it's always a privilege to spend time with you. Working from home today, so I apologize. You probably hear my puppy in the background, but
of course,
he'll settle down in just a few moments. He has a habit of getting all excited right about the time I get on a podcast.
Of course.
So I apologize.
We appreciate that. What's its name?
So his name is Pretzel.
Oh, that's a good
one. And I have to say that Pretzel's been a real joy for me during this difficult period of being locked down, locked in, and just a little bit of a bright spot in my day. So
I can imagine.
Thank you for your tolerance. I grew up in the automobile business. My father was a dealer. I've worked around the dealership all my life. I sold my first car when I was 16 years old. I was a dealer for 13 years in Chicago, Cadillac GMC truck dealer. And sometime in the late 90s, I had the good fortune of having the opportunity to get involved in a small but fast-growing technology company called Digital Motorworks, which extracted data from dealer management systems, cleansed the data, normalized it, and then we supplied data in real time through all sorts of different solutions, including Cars.com and Auto Trader and all the OEMs. It was a moment in time in the late 90s, early 2000s when everybody wanted automobile data online, and we were the go-to guys. We had the opportunity to sell that company to ADP, which is now CDK, in 2002. I went to work for them, and I had the good fortune that they fired me after a year. And I went out and I started vAuto and grew that company in 10 years. Well, actually, short of 10 years, I would say 7 years later, I had the very good fortune of selling it to Auto Trader, which is now Cox Automotive. And I've been there for the past 10 years, and they've been the best professional 10 years of my life. It feels like I have the opportunity to play every day in the biggest, coolest sandbox in the industry and sit right smack in the middle between the preeminent wholesale market of Manheim and the preeminent retail markets of Auto Trader and Kelley Blue Book. So I sit here today and have the amazing challenge of trying to make sense of a crisis that came up on us suddenly and unexpectedly, and in 3 or now 4 short weeks basically changed all of our worlds. So although there's a lot of pain out there for which I have sympathy, for me personally, it's an exciting time because seldom do you get to see the world change so suddenly and have the opportunity to make sense of it. And that's where I'm at today.
Wow. What an impressive background and a lot of fun. I can imagine comparatively growing up in a family car dealership and having an operational experience very similar to yours. We have a real appreciation for the innovation of the franchise dealer and even the independent dealer for that matter. Dealers figure the path, and I would just be curious if you were to comment on what are the things that you're encouraging dealers to really pay attention to? Obviously cash flow, retention of quality employees and things of that nature, but are there any big items that you say these are must do's that you have to pay attention to during this crisis?
Well, I think you touched on a couple of the very important ones. First and foremost, in this crisis, I think that we have to be concerned about the health and welfare of our people, their physical health and their financial well-being. And I'm really heartened by the fast, quick response that dealers have taken on these points. And of course, I'm also heartened by the fact that people who work at dealerships really understand and empathize with the franchise dealers' dilemma of having built a strong organization over many years, but have watched their business drop off, in some cases, virtually to nothing. So, everybody's in this together, and we all need each other more than ever. But, beyond the people side of the business, which, again, I consider the most important, inventory is a looming issue, both new and used vehicle inventory. So I definitely have a perspective with respect to new and used vehicle inventory, and I'd be happy to share that with you if you'd like.
That'd be great. Yeah, we thought you might have an opinion on inventory. Good for you.
Yeah, I've been known to have a few opinions in my time. So, with respect to used car inventory, what to do with it really depends on what your thinking is in terms of how quickly we come out of this crisis. If you think that we're going to resume to some normal pre-March type of environment, then it would suggest that you really don't take any drastic action with your inventory. If, however, you are of an opinion that I am and we are at Cox Automotive, that we will come out of this, but it's not going to be quick. It's not going to be in the next 30, 60, 90 days. It's going to take a while. There are some facts that are undeniable about your used car inventory. And the first is that in just a few short months, every vehicle that a dealer has on their lot today is going to be one model year older. No denying that fact. Fact number two is that there is a large growing supply of vehicles in the wholesale market. Speaking for Manheim, I can tell you that since March 15th through the middle of April, the number of vehicles that have arrived at our auction sites is growing by 100,000 units. And sales are not robust at all. They're down roughly 75%. Suffice it to say, there's a large and growing supply of used vehicles in the wholesale market. And fact number three is that we don't anticipate strong retail demand coming back anywhere near the levels we previously had seen them prior to March. And to support that thinking, you just have to recognize that in the past 3 weeks alone, 22 million unemployment claims have been filed. We're expecting another 4 to 5 million this week, and there'll be more beyond that. And that suggests that there is and will continue to be a lot of financial stress in households across America. And in any financial downturn or time of financial stress, the first thing to go are large discretionary purchases, large ticket discretionary purchases, which certainly automobiles are for most people. So it's going to take some time before people get back to work and they dig out of their hole of bills before they're really going to feel good about buying vehicles again in any sort of quantity. So stop and put those three pieces together, David. You've got aging vehicles, model year aging vehicles. You have high supply in the wholesale market and low retail demand. And there's no principle of economics or force of nature that I'm aware of that would suggest that when you have high supply and low demand, anything will happen other than a reduction in price, yes, reduction in value. And this is, in fact, what we're seeing. In the wholesale market, unlimited volume, and that needs to be understood. It is limited volume, but on the limited volume that we are seeing trading in the wholesale market, prices are down on average about 12%. So I think it's fair to say that every dealer sometime mid-March woke up and they all had negative equity in their inventory that they didn't have the day before, and quite a bit of it. And I don't necessarily see those wholesale values coming back in any sort of strong way. They may decline further, they may hold steady, or maybe they do come back a little bit. But I don't think that they're going to come back pre-COVID levels. So if a dealer owns their vehicles for too much money, I think the recommendation to do a reset is wise. In other words, let's get out of those vehicles as quickly as possible. Let's actually consider them all to be aged, because that's what happens to age inventory. You get wrong in it. You own it for too much money, you get negative equity or water. So I think it would be a healthy recommendation for dealers to take to look at their inventory right now as if it's all aged, and a good bit of it may already be aged. But if they viewed every car as being aged because they probably own it for too much money, we all know what we need to do with aged inventory. We need to move it out. It might be painful. It will be painful. But to do it now will likely be less painful than to do it later. So reduce inventory. And I think that recommendation, first and foremost, serves the dealer's interest in simply giving them cash, having cash reserves, which are very important in economic downturns. You know, the business will likely be off for a while, but your expenses will continue. So to convert some of your cars to cash will help secure your viability in the coming months, which are likely to be difficult. And after you have your expenses covered with that excess cash, it gives you the amazing opportunity to go into this new lower priced wholesale market and make hay with it, buy cars that replace your inventory and have a lower cost basis and compete in that new environment. So I think for that reason, converting cars to cash is the order of the day.
Yeah. So of course, timing is everything, right? So if you are in a position like that, and dealers are monkey see, monkey do to a large degree, they talk at 20 groups and all these communication platforms that are going around, everybody rushes to dump inventory, so to speak. The economic platform is then prices all lower. And then the question becomes, who's the buyer? And are these dealers in this marketplace buying from each other at a reduced cost basis and building inventory for that presumed future? Are prices low enough now to where there are assuming good deals to be had? If you project out and say you buy something 2,000 or 3,000 below what today's marketplace is, will you be able to sustain that if you turn 25% of your inventory into cash and 75% into reduced cost for future business? And I think that's a real strength of your technology, vAuto, is you've learned so much of this. And you and I, we got to present in Mexico, ironically, for BMW Canada last year. And one of the big concerns they had, the BMW brand, was we've got a lot of these 3 Series coming back in from leases, assuming the marketplace is not going to be able to absorb them, what's going to happen to the value? And we got back into the lessons that you taught us in the book Velocity. We have to turn, and sometimes we got to work on a thinner margin. Will some dealers get to the market and not have a marketplace of buyers necessarily, and sometimes forgetting the margin? It's how much cash can I generate and how much loss can I withstand? So I know I've thrown a lot out there, but pick through what I've covered and let's kind of talk through, what the marketplace is, who the buyer is, and should dealers actually be buying back inventory from across town rivals that are now at a good value in the market, or presumably a good value?
Yeah, well, there's a lot there. So let me just address some of the points that you made. First of all, I think it's interesting that we are now approximately 4 weeks into this crisis. And although the used car market at the wholesale level has dropped on average 12 percentage points, retail prices have only dropped 1%.
Wow. So
that suggests that dealers have not yet come to terms with the fact that we have a crisis.
Yeah.
And they're in their cars for too much money. And when I talk to dealers and ask them, why aren't you taking action on your pricing to move these cars out so that you can replace them, basically the same cars for a lot less money? I hear a variety of answers. One answer is, well, I think things are going to come back pretty quick and I don't need to take any markdowns or drastic action. Well, okay, if that's what you believe, I get it. I happen not to believe that. But I also hear quite often from dealers, I can't afford it. I don't want to take that loss. Yeah. And, my response to that is, David, you've already taken the loss.
Yeah.
It's already there. It's just a question of when you choose to recognize it. And the sooner you do it, I think the better you're going to be for having done it. So interestingly, for those reasons, and I suppose others, dealers have not come to terms with the fact that there's a crisis and things have changed and their cars are too much money. Now, another point of recognition is that at the worst time, which was around the end of March, beginning of April, overall sales were down across the country approximately 65% from a year earlier level. And you also have to note that that is very geographic dependent. Much more so, in some cases, the markets were down 90+%. In other cases, they were down as low as 20%. So it really was very geographic dependent. But overall, at the end of March, sales were down across the board, both new and used, fairly closely, around 65%. Now, fast forward the clock to where we are today, mid-April, or a little later than mid-April, April 22nd, sales are only down 40%. And that's a function of a few different things happening. Number one, some states that were previously closed have now reopened. The definition of essential services has been expanded to include sales of vehicles where previously it may not have. It's also being driven by factory incentives on new vehicles. And then most recently, the stimulus checks. Last week, 80 million households got a check for anywhere between $1,200 to $2,400. Another 60 million got checks in that range this week, and more to come in following weeks. Our research at Cox has told us that 7%, which might not sound like a lot, but 7% of people say that they're going to use that stimulus check to buy a new car. I mean, that's down payment money, $1,200 to $2,400. Well, if you take 7% of 120 million people who got those checks, that's about 8.5 million cars that people are out buying or intend to buy. So I think these are the reasons why we're seeing an uptick in sales coming back. What I don't necessarily think it reflects is a general belief, or I shouldn't say it doesn't necessarily reflect a general reality that, this is passing and we're coming back. There may be a little bit of that truth, but I think largely speaking, it's being stimulated by factory incentives, by governmental decisions, and by government stimulus checks. So this recovery, that's often been hypothesized as being either a V or a U shape, may actually be a W. And that would actually, at this moment, be my best estimation. I think we're seeing a lift in sales, which might look like a comeback, but I think it's probably more stimulated by the things that we talked about. And what I do believe is that with 22+ million unemployment claims in just 3 weeks, it's going to take a while for this thing to come back. So with that context, you ask about dealers buying cars. I think that there are going to be tremendous buying opportunities in the wholesale market. There are a lot of cars at wholesale, as I said right now, just at Manheim auctions alone, just shy of 500,000 cars, roughly 470,000 cars sitting unsold. Now, I'm not saying it's easy to go there right now and buy these cars because presently there's a pretty big gap between what sellers will take and what buyers are willing to offer. Yeah. But what we do see are dealer inventories starting to come down. And as those inventories come down, and right now there's about an 86-day supply. A year ago, used vehicle dealers' inventories were sitting around a 46-day supply, or excuse me, 44. So it has almost doubled. But as those used vehicle inventory levels come down, in which we think at the current pace, it will probably be around June 1st, dealers are going to start looking for cars. They're going to start returning to the auction. And as the demand at the auction increases, I think prices will be steadied. I don't know if they'll go up. They might go up a little bit, but they'll at least, I think, cease to fall. And I think the commercial sellers will have the pressures to lower their starting prices. So I think we're going to start to see some more wholesale activity, roughly speaking, in the next 6 weeks. So I think if dealers, sell down from their current 86 average day supply to their usual level of supply this time of year, around 44. I think they have plenty of inventory for the next 6 weeks. And I think 6 weeks from now, we'll start to see wholesale activity really beginning to pick up. So I don't think dealers necessarily need to buy cars across town from competitors. I think they primarily need to sell down the inventory that they have right now.
Gotcha. So the favored technology right now is digital retailing technology, and embedded in all digital retailing is a trade-in valuation tool. And if the consumer is self-serving or they're working through this with a guided approach by a salesperson at the dealership, they're going to come to that point of value for the trade-in. I would just be curious how quick the technology is and how trusting dealers can be with respect to those values that are built into those digital retailing platforms.
Right. Well, there's a couple different things there. First of all, one of the great questions at this moment is, what's the value of a car?
Yeah.
I don't know in my career that there's ever been as much uncertainty about what a car is worth as there is right now, primarily because there's so limited volume of sales at the wholesale auction. And number two, I've spent a lifetime convincing dealers that the best way to know how to get in a car is to first know how to get out of a car, and therefore look at the retail market. But at this particular moment in time, I don't even think the retail market is reflective of value, because, as I said, for the most part, dealers have not adjusted their retail pricing to reflect the reality of this crisis. So the best reference point that I think is available to us in the industry today is probably MMR adjusted by what Manheim calls the retention value. So the retention value, MMR by design is a value that is not supposed to be herky-jerky. It has a smoothing component in it, because you really don't want, from one week to another, depending on weather or circumstances, at any particular auction or set of auctions, you don't want to have a knee-jerk reaction to a very temporary situation in the wholesale market. So Manheim has really lagged, MMR, I should say, has really lagged true actual values. And Manheim's the first one to admit it. So they have developed what they call the retention factor, which is really a percentage of MMR that we believe in the current market vehicles are worth. And MMR is starting to come back, because it's starting to drop off the pre-COVID sales and start to look at the COVID environment sales. But right now, it looks like the best reference point we have for a value of a vehicle is Manheim retention value is somewhere around 94%, 95% of MMR. So I think if you looked at MMR and backed it up 5 or 6%, I think you probably have the best reference point available today in terms of what a car is worth. Now, having said that, you're quite right. This experience, and I think it's one of the silver linings of this crisis, is that it has thrusted dealers into the digital environment. It's probably accelerated it by a decade, I think.
Yes.
Every dealer today recognizes that they have to have a high degree of digital competency to sell a vehicle. And part of selling a vehicle in the virtual digital environment is putting a value on a trade. Well, there are a number of tools out there today that will provide a firm bid on a car. Cox Automotive's tool is Instant Cash Offer. And Instant Cash Offer was actually turned off for a very short period of time while we were still trying to figure out what the heck was going on and what the car was worth. But it's turned back on now, and it will provide a consumer a firm bid on their car. And I have to tell you that I think it is a bid that today is probably most reflective of what the car is worth in the real market. It might not be reflective of what the consumer thinks the car is worth, but listen, we're all coming to a reconciliation that cars are not worth what they were worth just 3-4 weeks ago. Yeah. So, I would say that, the online firm bid offer for a vehicle is alive and well, and fortunately so. again, you might not like the number, but it simply is what it is in today's market. So I think that digital commerce is enabled, and customers can like the number or not like the number, but it's pretty reflective of reality.
Good. So I would assume that a lot of people are probably listening to this saying, what does MMR stand for? So tell us a little bit about that index and why it's a big driver for the market.
Well, MMR is the Manheim Market Report, and basically, with some adjustments, it averages what recent sales of vehicles of that type have sold for at the Manheim auction over the past several weeks. It is adjusted somewhat for mileage and for extraordinary conditions, but it basically reflects recent sales at the Manheim auction. So I think it's, traditionally been the primary used vehicle wholesale benchmark. And unfortunately, as I said a moment ago, for reasons that are actually built into MMR, it's not designed to adjust immediately to abnormal, week-to-week events that like the likes of which we've seen in the last few weeks. So it lags a little bit behind what might be current market value, but as I referenced, the Manheim retention modifier makes an appropriate adjustment.
Good. So you and I both know, growing up in the business, when you go to the auction, all the cars are high if you want to buy. And when you go to sell inventory, all the prices are lower. And then you got to go back and explain that to people. I've done that to my dad too many times over the years. But in this situation, is the auction a good path for a reduction of inventory, or are you recommending a sell down direct to consumers so that you are able to retain customers in your system, potentially driving some fixed operations revenue down the road? What's your path to reduction?
Well, I'm always advising dealers that the better path, the best path to liquidity is through the retail market, even if you have to accept the wholesale price of the vehicle, because for the reasons you said, you have an opportunity to acquire a customer, have an F&I opportunity, and ultimately a fixed operations opportunity. So I think liquidation in the retail market is always a better option. I will tell you, however, over the past several weeks, there's been a fascinating story that has unfolded. There's a large national retailer, which I won't mention their name, that over the course of the past 3 weeks has put over 1,000 vehicles on OVE. Now get this, David. They had a starting price roughly about 50% of published MMR, and no reserve, 1,000 cars. Wow. They said, okay, we'll let them go for roughly 50% of MMR as a floor and no reserve. Well, interestingly, what has occurred is virtually every vehicle is sold, because there was at least one bid on most every vehicle. Mm-hmm. And when the vehicles did transact, they transacted at an average price of about 90% of MMR. So they took a haircut, but it wasn't a buzz cut. Yeah. So in my mind, that particular retailer was either desperate for cash, for liquidity, or they might have just been brilliant, or some combination thereof. Yeah. Because they liquidated 1,000 vehicles of inventory in 3 short weeks. And as I said, may have taken some hit, but not a tremendous hit. Now contrast that to another large, this next second scenario I'm telling you is a large commercial seller. They have tried to sell an equal number of vehicles, opening bid somewhere between $1,000 to $2,000 back of MMR, and they sold virtually nothing. Wow. So isn't that interesting? That first example I told you, they actually sold for $1,000 to $2,000 back or more and sold virtually every one. But the second seller that opened or put a floor price of $1,000 to $2,000 back of MMR sold virtually nothing. So why would that be? Well, I think it just simply has to do with psychology.
Sure.
Psychology of an auction. Yeah, it's fascinating. But having said that, I guess the point of this lesson is that you can sell vehicles in the wholesale market. You're probably going to recognize that 10 to 12% reduction in price. There's likely no avoiding that. So you can do that. I think this first example I told you is evidence of that. But for me, if I were a retailer, my first option would be to liquidate in the retail market.
Yeah, I would think so too. You know, what's interesting is all things tend to balance out. So if I'm a happy-go-lucky consumer, all of a sudden, the middle of March hits, I end up having a new job shape take place, and I want to take advantage of the 0%. I want to take advantage of the deferred payments and the cancel payments. Let's just say I'm buying a Ford product and I've got 6 months to play with. So I go into the digital retail tool and I'm moving down there. I'm like a lot of people, I actually owe money on my trade-in. So I get to the trade-in value tool, and a couple of weeks ago when I was curious about it, I looked at the value, and now I'm looking at it today. I'm probably going to hyperventilate a little bit and realize, oh my God, that's the gotcha. That's the catch. And so how do you load the lips of a salesperson who's sitting here saying, well, now we can offset because we've got the 0%, we've got the additional incentives, our dealership's going to give you, the best market value that we possibly can for your trade-in, but you're about $2,000, $3,000, $4,000 below market compared to what you owe on the vehicle. But let's go ahead and make the move now. What's the right approach, Coach? Put me in. I'll say what you want me to say.
Well, I don't think it should be too hard for consumers to understand that there's been a change in the world, and a pretty significant one, and it obviously has to affect the value of their trade. I mean, who doesn't understand that or is incapable of understanding that? But offsetting that hit on the trade is perhaps some of the greatest incentives on the new vehicle that we've ever seen in our lifetime. So one certainly does cancel out the other. And I don't think the real problem here is going to be as much of the customer understanding the value of their trade, as much as they might not like it. I think they'll understand it. I think the real problem is going to be the negative equity. Yeah. Because, that can't be explained away. The negative equity is the negative equity. So I don't really think the real problem is with the customer's mindset. It may take a little bit of work to simply explain to them, hey, we'd all love to have our cake and eat it too, but there's been a crisis, and you're taking some devaluation here in your trade, but you're getting it back and more on a discounted price on the new vehicle. I don't think that's the hard part. It's not, beyond anyone's understanding that this is reality. But the negative equity is the negative equity. Yeah. And that might ultimately be the hardest part to deal with.
So it tends to come back to the finance markets, and we've all sat in that chair and tried to structure deals and work with that, getting paper bought, if you will. So I've been trying to rationalize with this, and I'd love to get your opinion on it. How are the finance institutions going to handle momentary furloughs, kind of like in baseball terms, the asterisk next to the home run count or something like that? So I worked at this job for 10 years. I got furloughed for 8 weeks or 10 weeks or 3 months. And then I got rehired, enough, even thinking from the mortgage industry, but let's just stay on automotive. The dissection's a little easier in automotive, and I think you have more fluidity with respect to, or perhaps more flexibility with respect to that rationalization. But what do you think the finance companies are going to do with momentary job losses? And they're projecting into the future. Will this historically good candidate who's always paid their bills or reasonably paid their bills they're a 700 or, a reasonably good score, what's the future projection? And what's your opinion there? Because I've certainly thought that's going to be the big challenge, is getting paper bought.
Yeah, and this is a big question because as most people know, the lenders that car dealers deal with, they take all those loans, they package them up, and they sell them as asset-backed securities in the open market.
Yes.
And my understanding at the moment is that the buyers for packages of auto loans has really gone away and closed up considerably. So just yesterday, I was made aware of the fact that the Federal Reserve is opened a window to buy asset-backed securities of auto loans and other types of loans. So I'm heartened by that, to the extent that there will be a market for banks to offload those loans that they're making to people at car dealerships, which is the first important step.
Yes.
But that doesn't necessarily mean that the advances or the credit. I do know that the credit criteria is going to be raised, and the advances will probably be curtailed. So the loans that the banks will be making, in the most part, will be higher quality loans, because that's what the government's requiring if they're going to buy those, that they have to be decent. So that's going to flow downhill. So I do expect that dealers will see a higher standard of criteria for creditworthiness, and the advances will probably be leaner. Now, does that mean that they won't loan to somebody who's furloughed? I don't necessarily believe that's the case, providing there's sufficient credit history and prior income verification. But there's no doubt, the lenders, the buyers at these banks are going to scrutinize the paper more carefully. So it is what it is, but at least we have an outlet for those banks to securitize that paper, which, if that wasn't there, they wouldn't be making any loans.
Yeah.
And that was a method that was created in 2008 during that last financial crisis, because at that time there were no buyers either. So, the government's definitely helping out here.
That's good. It's important to have that kind of back safety net available. Dale, that plays into the new car market, and we could talk on this forever, but just, if you would, just give a perspective on new car inventories and the drive for that, because if advances are down, we have all studied the new car marketplace, and a lot of dealers are selling back of invoice, and they're making it up in finance. But if the advances are lower and we're unable to add product to some of those loans, we're really going to see a crimp there. So any just general guidance on new vehicle inventories and deal making?
Yeah, I think the big question in the new car inventory segment is the disruption to the OEM supply chain. It is going to take them some time to reconstitute themselves such that they can produce vehicles in a fluid nature. So put another way, I think there is going to be some new car inventory shortage. That's the bad news. It's difficult to say, how severe brand by brand, but I think generally speaking, there's going to be a delay in restarting all the factories, which may create ultimately some shortage. That's the bad news. The good news is, at least as of today, there's approximately 130-day supply of new vehicle inventory sitting on dealers' lots. So depends how long this COVID thing lasts. If the all clear come back to work signal was uniformly filed today, we'd probably be okay. But the longer the supply chain is disrupted, the likely gap between dealers inventories and the factory's ability to replenish them may come into play. So what does that mean? I mean, some dealers would say, well, then I'm not going to be so quick to sell my inventory, or I'm going to hold out for higher prices, or I'm not going to discount it. My advice always to dealers is don't try and run your business today based on what you think is going to happen in the future. Because listen, none of us can predict the future consistently correctly. I think as a retailer, the best advice is to run your business based on the realities of today. And that might mean that you could have come out better if you had guessed what the future would hold and took a different course of action. But it might also mean that you might get hurt and come out worse. Yeah. So I don't think you should be a gambler. I don't think you should be a speculator. Deal with the reality and the facts as they are today. And in my mind, that is sell cars. Sell cars. Now, the one cautionary note I would give you on that is don't be overly anxious to sell cars, particularly if it means that you have to overappraise a trade-in. And I have seen this happen. I mean, in the moment of a crisis, there's an attitude in dealerships to make every deal work, make any deal work. And when you translate that into action, all too often it means step up to the trade. Well, I would not be stepping up to trades. If I had a choice today as a manager or a dealer to step up on a trade to make a new car deal or to pass the deal, I'd pass the deal. Because I'm going to get financial incentive from the manufacturer to move that new car. And it might ultimately even be in shortage. But they're going to give me rebate money, they're going to give me interest credits. But if I move that new car by stepping up, putting too much money in a trade-in, there's nobody who's going to give me financial assistance to get that trade-in off my books. No doubt. So sell cars, but do it prudently and cautiously, at least with respect to valuation of trade-ins.
Excellent. Dale, this has really been a lot of fun. It's interesting you use the word heartened, and I'm heartened to know that as we talk through this, there are some bright spots, there are some opportunities. We are innovators when it comes to automotive, and I think what'll be a fun outcome as we go through the misery of all this, and you think of the health of coworkers, of family members, and all the poor people who have lost their lives and their loved ones. This has just really been a remarkable crisis. And what we want to do is to think our way through the future to where we retain a safe working environment. We paramount to everything else, put the health and well-being of our employees and our customers at the forefront. As a wrap-up, any prognostication with respect to how this will reshape our industry and us as humans, so to speak?
Yeah, no, thank you. I think you said it very well. I think this has really been an incredible period for personal reflection. There's no question that we're going to have a new normal, and it's going to be different than life was before. And, it calls a lot of things into question. And I think it's a really interesting and valuable time for personal reflection to think about what really matters and what really doesn't matter. And on a professional level or an industry level, I think there are definitely silver linings from this. One silver lining is that it has thrusted all of us into the digital commerce age, where we likely were lagging a lot of other industries. So I think it's thrusted us a decade forward in a matter of 3-4 short weeks. And that will serve dealers well, both in the crisis, beyond the crisis. And I also believe that any downturn is capitalism's form of natural selection. The weak will not survive, and the stronger will be stronger for it. So we're all going to learn how to operate differently, like in a digital environment. We're all going to learn the cost of operational inefficiencies. In other words, we're all going to become more efficient. We're going to be smarter. We're going to have another notch in our belt. And when we get through this, we'll all be stronger for it. So I'm heartened. It's not all bad. I mean, in any crisis, there's pain, there's confusion, there's chaos. but there's always opportunity.
Absolutely. And with that, we'll wrap up our interview with Dale Pollak. Dale, you're a gentleman as always, and thank you very much for taking the time to spend with us this morning. That was very important to our company and to our customers, and certainly to the greater industry. Thank you very much.
My pleasure. Thank you, David.